Hey, how's it going? I got some new cards with the new picture. Stop by my office and pick some up. Hand them out liberally. Uh, what are rates doing here? Rates are about the same, a little bit better in some cases. 30-year fixed conventional, still about 7%, but it's costing less and less as time goes on. Consumer price index comes out tomorrow. Hopefully, that has a good effect on things. We'll see how it goes. VA has come down to meet FHA. For some reason, it kind of bubbled up a little bit last week, but those are both about 6.25 with no discount. USDA is just a little bit higher than that. Uh, if you do want to pay a discount, 1% of the loan amount added to closing costs puts the conventional conforming at about 6.625 with a larger down payment, 30 35%. Maybe you're selling and then buying. That could be better. That could be lower with the larger down payment. FHA is sneaking into the fives with 1% discount. So we're kind of going slowly in a good direction here. VA right around 6 with 1% discount. Uh, in the news, spooky but not so scary. The CFPB, Consumer Finance Protection Bureau, doesn't mean as much to the immediate mortgage industry as thought. The lines of regulation will go through a different entity. CFPB was basically a watchdog who people made complaints with, who then try to mitigate complaints or levy punishment. They did make things like, the loan estimate, the closing disclosure, our 3-day rules, and things like that. And they enforce those. Those will all still remain in place. So if the CFPB goes away, the business doesn't. There was some thought that it would stop the ratification of mortgage loans, but that's going to happen through the Federal Housing Finance Agency, the FHFA, which was created in 2008 to kind of run things. Big question is, are Fannie and Freddie going to be released from conservatorship and allowed to be basically publicly run, publicly traded companies again? The thought is, if that happens, guidelines kind of get tighter and maybe fees go up a little bit, because you go from having the government back in this thing, mortgage loans, to individual investors who have maybe a different risk threshold. So that's why we got to look at that non-QM stuff a little bit more, such as uh, talking to a builder. You want to make a builder happy? Uh, Builders' properties, just like sellers, are on the market longer right now. When that happens, builders can't go and build sometimes. Sometimes their credit line is full until a property sells. So builders, point two, need to open up their construction lending lines. And fortunately for you, you work with an in-house lender who can refinance these properties out of the business and into the builder's personal name, almost like they're buying it from their company. But if it's a purchase, the price that is set is going to be below market and is going to kind of kill the market for that thing. So we can't do that. I can do them as a refinance, refinancing the property out of the LLC or S Corp and into the builder's personal name, where they can rent it, hold it, do what they want to do with it. Uh, it's a non-owner occupied loan. We can do them several ways. I've got that interest only for the first 10 years. If we can't qualify for that because, let's say, the tax returns don't show enough income, we can go with a bank statements based loan, where we add up all the deposits for the past 12 months in the business bank statements and cut that number in half. That number tends to be better than the number reflected in our income calculation when we look at tax returns. To think 7.25, 7.375, maybe a point in there, but it's worth it. Um, Maybe a 1 year prepayment penalty, but it's not an ARM. It's a 30-year fixed. That's a great rate for a condo townhome investment property. And so, as you talk to builders, this is one more thing of value that you can offer to them to help them do their business. And you know what? That's it for me this week. Thank you so much. I'll see you tomorrow.